Be honest, how many days and nights you've spent on the charts looking for the perfect setup or the perfect pattern, the one that would bring constant gains over time? Have you found it yet? If not, I want to show you a simple and effective Forex strategy I have developed over months of research and study, and I will demonstrate how to profit consistently by taking advantage of the dynamics of price and time. This Forex strategy is based on two fundamental factors, two elements that leave no room for discretion: price and time. The main advantage of this scalping strategy is the fact that you don't have to spend hours in front of the charts to try to find all the various patterns like flags, head and shoulders, and so on. And you don't have to jump from one time frame to another looking for the conviction that the pattern you have identified is really worth trading. And it doesn't matter if you like trading with indicators or you're a price action trader. Both approaches will work with this strategy, because you'll be analyzing markets based on objective and non-subjective criteria, established with clarity and precision. If this sounds good, let's dive right into the strategy. First, let's talk about the time component. Forex is the world's largest financial market and is open 24 hours a day, 5 days a week. However, depending on where you are in the world, days and times may differ due to time zone and daylight savings time. Generally, the opening and closing times of the markets are indicated considering the GMT, meaning the Greenwich Mean Time. And you have to pay attention to the fact that in the various periods of the year, each country can have different time zones. These concepts may seem obvious to some, but it's very important, regardless of the platform you use, to know the exact time shown by your charts compared to the GMT in London. So very important, you should pay close attention to the time displayed on the charts, because it's not always the same as the GMT time, since for this strategy it's essential to know the opening and closing times of the various Forex sessions that make up the day. If we are misled by the wrong time on the platform, our analysis would be wrong. The trading day consists of several sessions: the European session, the American session, and the Asian session, also known as London, New York, and the sessions in Tokyo or Sydney. For those who trade Forex, and specifically trade intraday, it is therefore essential to know the times at which currency exchanges take place on various markets, and especially the times at which multiple sessions are opened at the same time. I have summarized the start and the end times of the main trading sessions in the London GMT time in this diagram. For this strategy, we are interested in the European session. For Europe, the session starts at 7 GMT with the opening of the Frankfurt session, but the main opportunities start at 8 GMT with the opening of the London session, while Tokyo is in the last hour of trading. At this time, a large number of traders are participating in the market. This results in larger price movements than in the Asian session, which often also prove to be of great impact on the sentiment for the day. We can therefore say that the opening moments of the London session are a good starting point to trade in a highly liquid market, as well as finding the best opportunities. With the opening of Europe, Frankfurt before, and London an hour later, the movements that are generated often create the trend for the day, giving us the opportunity to take advantage and capture a part of it. The trend of the day, generated by London, doesn't always remain that way. At the opening of New York session, the high volume of trade achieved combined with the publication of important economic data can cause large reversal moments that can also reobserve the entire movement triggered by London session. It goes without saying that even these reversals offer us the opportunity to seize another trading opportunity. Now let's talk about the importance of the opening price. Here's what you need to know when scalping and day trading Forex. The opening of the European session can cause large price movements that often result in important intraday trends. And the first factor to take into account in order to take advantage of these movements is the opening price of the European session. The opening price is the point from which all daily activities originate. It's a very important price level, according to which big traders move from a long vision to a short vision and vice versa. We can therefore consider the opening price as the crossing point representing the sentiment of the day. Here's the key point of this strategy. Most traders focus on the London Open, but smart traders know there is another important focus point prior to the London Open, and that is the Frankfurt Open. The opening of the Frankfurt occurs at 7 GMT and the opening of London at 8 GMT. During this period, There is an increase in volumes, but it's still not enough to generate real trends. Now pay attention. The price distance that is formed in this 1-hour interval from 7 GMT to 8 GMT determines the range that goes to form the opening channel. The opening channel contains the open price of the Frankfurt session and the open price of the London session. And very important, the opening channel is the area within which you never have to enter the market for the rest of the trading day, the no man's land. This example shows the opening channel from 7 GMT, the opening of Frankfurt, to 8 GMT, the opening of London. These lines represent the low price and the high price formed within this hour, thus determining the opening channel. The high and low price of the opening channel are two very important levels, because they are the first support and the first resistance for the trading day. Remember, we don't trade inside the channel. If the price goes above it, it creates an imbalance that triggers a force from the buyers, and vice versa. If the price goes below, the strength of the sellers is triggered. If the price is inside the channel, since there is no imbalance between buyers and sellers, you cannot know which direction to expect, either long or short. This concept remains valid throughout the trading day, during the European session, and even in the first part of the New York session. As we have seen, the opening channel, which has the opening of the European session within it, acts as a neutral price zone between buyers and sellers. When price breaks upwards, we'll have a long entry signal, while when it breaks downwards, we'll have a short entry signal. Obviously, the entry signal is triggered after 8 GMT, the opening of London, when the price breaks the channel upwards or downwards. Here's an example of a long entry. We have identified the opening channel, and soon after the London Open, we had an upward breakout. After London session opened, we can see the market traded within the opening channel, and then immediately changed direction and started upwards with a strong trend. And here's a short entry. After we drew the opening channel, the market immediately started a strong downward intraday trend. A short trade under the channel would have allowed us to capture a nice profit for the day. Where to place the stop loss? Stop loss, which is mandatory, must be positioned on the opposite side of the opening channel. For a long entry, stop loss goes a few pips below the opening channel low, and for a short entry, stop loss is placed a few pips above the opening channel high. The stop loss is positioned in this way because once entered in the market, in a short trade for example, and during the session the price goes back and breaks the opening channel upwards, remaining in the trade will no longer be sensible because the sentiment of the big market players, those who move the markets, passed from short to long, with the high probability that the trend of the day will change. At this point, it's clear that it no longer makes sense to insist on remaining in the market. Where to set take profit levels? Once you have identified the channel, enter the market after a breakout, and placed your stop loss, you must proceed to identify the future price levels at which you will take profits. To define these levels, the best thing to do is to measure the range of the opening channel and project it from the breakout of the channel's high price for the long target levels, and from the breakout of the channel's low price for the short target levels. And you have to do it multiple times, just like adding pivot points. You determine the first target by projecting the channel, and then the second target by projecting the channel once again, and once again for the third target for the day. When setting price targets, the opening channel is a measure of volatility. If the channel is narrow, you will have to add multiple price targets. If the channel is wide, you will have to add just a few. You can close 50% of your position once the price reaches the first target, and then let the trade run until the next target is reached. It's up to you. You decide which money and risk management you want to use. Now that you know the right ways to determine the take profit levels, it's important to mention that you will have to plot them immediately on the chart as soon as the opening channel has been formed. You should know that these price levels that you will add to the chart at the beginning of the session, in addition to being the ones on which we will place our take profits, they will also be the levels of future support and resistance. You will notice how these levels will be used by institutions during the trading day as real levels of support and resistance. In this chart, I have traced upwards and downwards levels of take profit, and it's evident how the price reacts when it approaches these levels. It's really unbelievable how accurate these levels are. The price bounces several times, reverses, breaks, and retests them. These price targets are very important. Knowing the support and resistance levels for the day in advance, right at the beginning of the London session, will certainly be a great advantage over the market. The great thing about this strategy is that it has a precise set of rules. You can backtest this strategy easily, and you can implement other types of analysis to confirm the breakout. If you are a price action trader, you can analyze swing highs and lows and trade breakouts in the direction of the trend. During an uptrend, you will have higher highs because buyers push the price higher, and lows are also higher because buyers keep buying the dips earlier. During a downtrend, lows are lower and highs are also lower because sellers sell earlier and buyers are not as interested. So if you spot an uptrend and you see an upside breakout of the opening channel, that's a high probability trade. A downward breakout of the opening channel, when the price is making lower lows and lower highs, is also a strong sell signal. If you prefer confirmation from indicators, moving averages are perfect for this strategy, because are great to identify the market direction as well. If you want to use moving averages as filter, you can apply the 200 EMA and then only look for trades in the direction of the moving average. In this example, we can see that we had a long signal above the opening channel and that during this uptrend, price always stayed well above the moving average. As always, if you learned something new and found value, and you want a follow-up video about this topic, leave us a like to show your support, subscribe to our channel, and hit the bell icon to stay notified when we upload new videos. Until next time.